Yeah, my name is Mark Nelson. I work with Kansas Farm Bureau. It's a pleasure to be here this afternoon, and I'm going to keep my comments relatively short. Seems like I get pretty verbose at times, but I'll try to keep this pretty short. I just got a handful of slides. But what I want to do is just kind of work through some of our templates, but I want to start here with just looking at the drought. Obviously, things are very dry, and I'm probably going to knock my camera off here just to get it off the screen there a little bit for me. It is dry, and we're moving towards where we were in 2012, right? 80% of topsoil is either short to very short, and it's getting drier. 73% of subsoil is short to very short. 61% of the wheat crop is poor to very poor, and really only 13 is good to excellent. So there's a lot of really bad wheat. A lot of wheat's not going to make it all the way, and obviously that's going to impact our wheat plan. Obviously, that's going to potentially start impacting our corn and soybeans, especially on the dryland side. Okay, so what I'd like to do is this real quickly is just go through some simple pre-harvest marketing plan templates. Kind of did that last month. These are templates we've put together from the Winning the Game team. But what I want to try to do here is share some relevant examples, kind of document our progress to date and some of the decisions that we're looking at for this crop year. Definitely do not want to say that these are recommendations or advice, but it's kind of a take it where we are, applying the principles that we teach in our Winning the Game workshops. And those principles basically are these. One, we need to decide on how many bushels we want to include in a pre-harvest marketing plan. Is it 100% of expected production? Is it 10%? Kind of depends on the tools you want to use. I've been in places and we've done workshops where folks have said, I don't want to price any more than 30% of what I think I'm going to grow. That's perfect. Let's figure out and create a plan to price that 30%. We've had workshops where people said, hey, I'm willing to use futures and options. I'll price 120% of my APH. That's good too. Typically, as a rule of thumb, we'll kind of say, well, whatever your insured APH is or whatever coverage level you are insuring is a good place to start, because that way we know it's a nice way to marry our crop insurance plan with our marketing plan. So we're going to put into our pre-harvest plan those bushels that we know we can cover. So that's the first decision. And basically it comes down to what is your comfort level. We talk about incremental sales, and really that gets at how many pricing decisions do you want to make. In our examples, typically we'll use 4 to 5. Again, larger producers will probably want to have multiple and even more decisions. But again, how many increments? Because then so many increments, so many bushels per increment. Price targets. We spend a fair amount of time in our workshops talking about price targets. We try to set those price targets at incrementally greater levels because, in the big picture, when you're creating this marketing plan, the whole goal is to create a plan that you can, you do that pre-harvest, you do that before you start, you have a plan that can handle bullish prices, you have a plan that can handle bearish to sideways prices. You want a plan that you can pretty much will apply to almost any marketing situation, because our whole goal is to take the emotion out of our pricing. And so in tune with the price targets, we want to have some decision dates. The price targets are great because as prices go up, you're selling at these higher targets. If we're in a year like this year, where we're seeing, largely sideways to down prices, these are dates that you will take action regardless of price. Now, what we do a lot of times when we set these decision dates is we kind of aim for those seasonal highs. So even though it's not a great year, the odds of us pricing when prices will be as high as they are going to get are greater when we do it this way. So we'll run through what we've got. Never price below your estimated cost of production, right? That's one of our rules that we put in, or at least a guide. We don't want to see people pricing their wheat, pricing their corn, pricing their soybeans at levels that are below your estimated cost of production. So calculating cost of production is important. In a year like this, where dryness is starting to impact yield potential, these could be shifting targets. Catch up. If we pass a decision point due to low prices, right? Prices are below my cost of production, so I'm not going to price. when prices rally and get above that, let's make some catch-up sales. Last thing, we never talk too much about pricing tools because the key is you've got to use what you're comfortable with. In our workshops, a lot of people say, hey, all I like to use are forward cash contracts with my elevator or the feed yard or whoever I'm working with. And that's great. That may impact the number of bushels you want to price. But again, that's fine. Create a plan that you're comfortable with. If you're looking at some of these more, I'd call them advanced market strategies, we've had some questions on our webinars before where people talk about, hey, I want to put on a minimum price contract. I want a forward contract, maybe buy a call, and then I want to sell some calls to try to cover those. We don't spend much time talking about them in these workshops because, it's a bit more advanced. And I think at that point, you need to be working with your broker. Nothing wrong with those strategies, but those are definitely things you want to implement as part of a marketing team and working with your broker. So let's take a look here. I'm going to start with the wheat. This plan we started back in October of last year. Again, our target was to price 80% of our APH. Last month, we talked about the fact that we're in the middle of a drought. Things are bad. Our yield potential is definitely down. So we said, let's only price 60%. That still may be a little bit aggressive. We also moved our target up. We had an $8 minimum price target that we would ignore decision dates, make no sales if prices were lower than $8. We moved that up to $9 because of decreased yield potential. The key thing here is how many bushels are you all folks pricing? Because those numbers definitely on the wheat are shifting. To date, we've priced one increment, which in hindsight turned out to be about 27% of our APH because we are knocking that thing down a little bit. Here's what it looks like on the chart. Basically, I grabbed this and updated this chart mid-morning today. But in October 1, we saw July hard wheat, red winter wheat futures at 960. I'm just kind of reading across there. And shortly after that, we priced our first increment. Again, which in hindsight turned out, we thought it was 20%, turned out to be 27% of our APH expected production at 996. We're fairly happy with that at this point. Currently, prices are like I say, last time mid-morning, they were about 860. If we adjust that for basis, that's giving us prices at 850, 816, 825, various locations across the state. At this point, I'd argue that may not be covering our cost of production, so we hold off, right? We hold off. We've got support at 764. We've got a little bit of resistance at 890. I think as we listen to, and we need to do that when we listen to Dan's outlook, he'll talk to us about where he thinks prices could go. I think he's a little bit bullish. And so definitely, we're not going to be taking action at these price levels. I would say we're looking for 935 at that point. We're closer to maybe covering our costs, and we try to make a catch-up sale. Because again, we've got 27% priced. Our goal at this point in time, right, mid-April, is to have 60% priced. We don't have that done yet. But if we can see a good rally, again, up to that, say, 935 area, maybe we do an incremental price at that point and then see if we can rally these prices higher. Something I want to talk about, and we talk about this sometimes in our workshops, is, obviously our goal is to maximize profits, right? We all want to do that. Our plan says never sell below your expected cost of production in the pre-harvest phase. Last month, our estimated cost of production, we increased that up to $9 a bushel. We're not there. A question that sometimes we all need to kind of think about is this: would it ever be preferable to price a portion pre-harvest, even at prices less than your cost of production? At that point, we're just trying to minimize losses. I think, again, let's see what Dan has to say, but I believe he's going to tell us there's probably little downside risk, and we do have some opportunities to maybe see some higher prices. So at this point, definitely wouldn't do that. But as we look at corn, as we look at soybeans, you may need to do that. Now, at this point, I think we can price soybeans for sure at prices above our cost of production. So I think we're in better shape there. Always use caution when you're adjusting your plan. On the feed grain side, here was that template that we had, again, ensuring at 80% of our HPH. And we include those then as part of our what we want to price. And so we've got 5 increments, pricing 20% at 610 December futures, or by March 1st or 15th, we've got that done. We priced 20% at 570, not a great price, but when we got that in, we were already behind. Second increment is 20% at 6:30. Again, we're a long ways from that December futures, or by April 15th. We're behind on that one, right? We're not there yet. Now it's already past April 15th. We want to ignore decision dates, make no sale if prices are lower than 550 local cash corn. Again, here's that chart of it. January 1, that's typically when we start our templates. December corn futures were 607. We have yet to close above that since. So definitely we're in a sideways to down market. We went ahead and got that first one done on March 29th when we saw that rally. We got up to 570. So we went ahead and did that. That's not a great price. For the most part, that's break even for a lot of folks. Maybe some parts of the state you're not. But we went ahead and got that done. Where do we go in the future? Well, we're 20% priced. Our goal at this point in time would be 40%. So we're looking to make some catch-up sales. At this point, I'd say maybe 580, because at that point, I think for most guys or most farmers in Kansas, we'll be pretty close to a break even. Let's get that done, making the best of a bad situation. Maybe looking at 598 for that third increment, because that's a place where there seems to be a fair amount of resistance. And again, I think we need to always come back then and see what Dan has to say as far as where his outlook is. When I look at what he's saying, kind of glancing through some of his slides, he seems to be a bit more bearish on the corn side than maybe he is on wheat or soybeans. And so again, maybe getting some of these sales in, we might be pretty happy with these if we can cover our cost of production. So again, looking the price at 580 where I can cover my costs, make a catch-up sale, looking maybe at 598 as a possible third increment. On the soybean side, here's our plan. Again, 5 increments, 20%, 20%, 20%, 30% come by June 15th, kind of close things out. And then the last 10 in July 15. Again, you see how we're increasing those targets, not hitting them this year at all. We've got 2 of those increments priced though. We have a ignore the decision dates, make no sale if prices are lower than $12 local cash. And again, kind of to go backwards on that, we calculated those by taking an average of all the non-irrigated KSU budgets for soybeans, wheat, and corn. And that's where we came up with our price targets. Putting that on a chart, we kind of look like this. January 1, we were at $13.97. Again, we got up to there and above it one time. So we went ahead and priced. We hit $14, which was a price target. Went ahead and locked that in. Then we hit our date, April 15th. We went ahead and priced that one. So we didn't get the price we wanted, but we hit a decision date that said price. So we did. We were covering our expected cost of production. So at $13.01 futures, we went ahead and priced. So we've got both of our increments priced. Today, or on Friday, we were at $13.01. That was kind of given as a cash price of $12.46 Topeka, $12.51 Salina, $12.26 Fredonia. Again, our estimates would say that's covering our cost of production for most producers. It's very important that producers calculate their own. At this point, we're 40% priced. We're right on target. Our next target would be $15. We'll have to see what Dan says if we have that as an opportune. Our next date is May 15. I kind of wonder, we do have an area there in that 1330 to 1340 area that it held as support there for a while back in January. It kind of served as here late in April, early April, it's kind of served as an area of resistance. If we can get back at that, we may want to consider pricing that third increment. Again, kind of want to look back and see what Dan has to say as far as his outlook today. But in a year where we might see prices just continue to move sideways to down, conditions and yields look pretty good for corn and soybeans in those key corn and soybean producing states. Hard red winter wheat, where we're king, it doesn't look good. And definitely, I think that could be later down the road. Moving forward here, I just want to touch on this. We had a question on some of the registrations. Question was this: when should we begin to look at our 2024 crop marketing plans? Again, we typically start October 1, feed grains, soybeans, January 1, but definitely, when you kind of look at some of those forward pricing crops, right? July 2024 hard wheat, 810 mid-morning today. July 2025 CME hard wheat was at 9730. December 2024 corn was at 543. December 2025 corn was at 495. Again, that might struggle to cover cost of production. November beans for 2024, 1240. Beans for 2025 at 1158. At those levels, you're getting pretty close to covering your costs on the bean side. Corn, a little bit tougher. My 2 cents would be, and again, we want to look at those outlooks, but if we would see a pretty solid rally this spring and into early summer, we definitely might want to start taking a look at some of those forward contracts and at least maybe doing an increment on 2024 corn, 2024 wheat, if we would see a pretty solid rally later this spring. With that, Dan, I tell you, I want to thank everybody, but I'm going to turn it over to you.
Yes, Mark, before you go away from that slide, you know, those lower prices that second year, they're all predicated on pretty decent crops this year and all that much more of a return to normal production next year. So that's the narrative. That seems to be the narrative of the markets. They're really not pricing in a tremendous amount of risk and uncertainty or fear at this time. So, okay, yeah. I'm looking at those price differentials.
I got it.
Yeah.
I'll share.
Okay. So let me get my slides up here real quick. Well, I appreciate the chance to speak with you today and to follow up with what Mark had said. And Mark, after I go through this today, if we have time, I'd like to circle back and take a look at where these comments you hear today, where they'd put us with regard to, particularly on the corn marketing plan that we have. And I know that here we just came to a decision date. I noted you're on April 14th that we didn't price, so I'm sure some people are probably wondering on that, given where we're at. But again, we just weren't at the cost of production. Is that correct?
That is absolutely right. And, you know, this is where we try to create that plan. And, you know, it says, hey, let's not do any harm. And I think if you look at this market and like I say, I'll be listening to you. But if there's some, you know, any kind of chance for a price rise here as we get into planting season and things, that'll create those opportunities to do some pricing and finish up and do some catch up. But yeah, I'd hate to price at a price I don't believe is covering my cost of production. That's for sure.
Okay, well, we'll try to move briskly through this, hit on high points. Don't hesitate to put in questions on the chat as you see them. Thought we'd take a look at where markets were earlier today anyway. Well, late last night, early today. Not a lot of positive carry in these markets. You see for corn from May to July, a 15-cent carry situation that actually should be divided in half. I think that's more like a 11-12 cent carry situation. Carry from July to September, from 633 down to 567, and then falling off into harvest. So already the market is at least by what it's seeing up front on corn futures. If my pointer is helping out. So we're still pretty much looking at the old crop storage market from May into July, but then from July into September already there's the expectation of things dropping. So you kind of see the leanings of the market. And here's this DEES 2023 DEES contract at 559. Mark, in our workshops, we talked about how in some years the highest price is early on in the marketing year. And I think for this one, the highest price for these contract, I think was the first week or so in December at 605. Now that's not saying we won't get back there, but at least so far we've been trending sideways to a bit lower in the markets. For soybeans, been a lot of volatility and a lot of worry about what's happening. Well, affecting corn market too. Down in Argentina, it's kind of a battle between Argentina's major losses, and Brazil's optimism in terms of where their soybean crop would be at. And of course, we see the hard red winter wheat crop, and I'll have several comments on that. But you know, for if we had a brisk export market that was giving messages to our hard red winter wheat sales system out here in the country that we need wheat, that we need to get hold of what we can, I wouldn't be surprised, given how dry we are, that we'd be higher than we are right now in the wheat market. But still, it's $8-9, et cetera. But fairly anemic, somewhat mostly spotty exports, and we're still holding up at this. You have to wonder where is this market going if we get more confirmation of major crop losses in the hard red winter wheat area. Just with we're in a way, the market's kind of beat down, you know, kind of pessimistic, given that we see what's in the out in the country, and yet we haven't really responded to it. So this is where the high U.S. dollar and the weakening of U.S. exports really affects us. I did want to put up here just a few other price signals that we try to watch. Ethanol plants in Kansas. There are some higher price top end bids in Nebraska, but on average, high and low across all of them, we have the highest average price for corn at ethanol plants here in the state of Kansas. Of course, we have Southwest Kansas leading the way on that. I did also want to show you well, this is in essence a set of prices across the state that we watch on a weekly basis, picking out Colby. Prices are in and around Colby to represent Northwest Kansas, Salina, North Central, Topeka, East Central, Northeast, Garden City, Southwest Kansas. Although Garden City area, we've been finding some good prices in Wright of late, a consistent series that we've been looking at. It's been good to follow for our purposes on the basis side. Hutchinson for South Central and Columbus. And just take note, Mark, you were pointing out that the break-even price wasn't, you know, we were not quite high enough. The new crop forward bid in the Colby area, for instance, 552, higher in the Garden City area, positive basis, and not just one or two elements down there. So the demand center for new crop bids for corn really stands out for Garden. Hutchinson, even money, par, a cent or so better, and really pretty good prices. In most areas across the state. We have had also some grain sorghum cash price movement, some export movement in kind of a herky-jerky manner. So one or two a good week, and then a week of consolidation and gathering, and then another good week. So on a week-to-week basis, we have seen some positive things happening in sorghum. And note that Topeka bid, actually the sorghum bid in Topeka at 705 earlier today, higher than the cash corn bid. So again, I see that happen in a location. You think, gosh, we're probably filling some trains, or we're getting ready to send something out someplace. And you see some pretty good bids. That Garden City new crop bid for sorghum at 9 under at 553, pretty good to consider. We've seen a jump up of late in soybean cash prices. The spot bids, and Mark, and I should have paid closer attention to what your break even was, but we're uniformly 1211 to 1251, 1255 for new crop bids for beans. And interesting to see how that's working out. Even well, at Western Kansas, you know, again, we're transportation issues farther out here, about 90-95 under for the new crop bid, in the 50s. Thereabouts in a lot of other places. And for wheat, again, we have 8s there. It wasn't that many weeks ago where we had dipped down in a number of these areas to just below 8 into prices starting with a 7. You can see the new crop bids there as well, all pretty uniform, really. So if we had more moisture, we'd be looking at these prices and having a lot more of a positive response to them. But I think our production uncertainty this year really tamping down some of our enthusiasm for marketing issues. Just want to show you what the broader market has access to as it looks to what's wet and dry. And So when you look at Kansas, it's hard to find another state that's more drought affected right now. And the darker the color is, I'm looking at the latest drought monitor on the right, on the left-hand side, all but east central Kansas really affected by drought in the state, and not just a small trifling amount. And predicted moisture, and on the right hand side, it's a predicted moisture anomaly. You do see all that much more of a spreading into Missouri, into parts of Iowa, of moisture problems, parts of the Dakotas, but for sure down in Kansas and Oklahoma and Texas. So tough stuff. Short-term objective drought looks pretty rough, and longer term, you can see the same areas. It wasn't, but a week or so ago, when it seems like when we caught some rain, some snow, that you'd seen that short-term drought, objective drought blend equivalent indice look better in parts of Kansas. But gosh, the hot weather of late brought us right back to where the short-term drought indicators are showing tough again. And again, on the long-term side, up into Nebraska, looks pretty rough, as well as the major chunks of where we're at down here in Kansas, Oklahoma Panhandle, and Texas Panhandle. And I wanted to show you this just to get an idea of where, I guess, from a global perspective, what we've got here in terms of where dry conditions are. Of course, you see in North America, our drought, there's drought up into parts of Canada affecting wheat, barley, etc. And then there's that dry area down in Argentina, parts of southern Brazil. Actually, that's mitigated a little bit. There was to the north of that reddish part in Argentina, you saw more dryness in southern Brazil here of late than you see right now. Some of the extremely dry conditions we saw in France, Germany, in those areas last year, a lot of that seems to have not showing strongly. You don't see a lot of dry conditions right now in the Black Sea region around Ukraine and Russia. You do see again the dry spots we had seen in India seem to be doing better. There's that one little reddish spot there that was a lot bigger part of the time last year, and then you do see some drought conditions in China, but less than there had been. And you see for the most part in Australia, pretty good conditions. They were showing a lot more drought than had been. So without trying to I guess say anything inappropriate, we're just we here in our part of the world and down in Argentina are some of the last holdouts on some of the dry conditions that we've been seeing around the country. And we'd sure be happy not to have that unique title, I think. Take a look at some grain market perspective. I've shown some of these slides in the past, but the general, but they've been updated a little bit. Still tight global corn, other grain, oilseed stock conditions of wheat. The wheat numbers tightest since, well, you'll see here in a minute. Again, ongoing importance of South America's corn, soybean, and wheat crops, all impacted. That the drought down in Argentina is called a 60-year drought. And the latest USDA numbers that came out on the April 11th WASDE report, as soon as they were out, just about the next day, the Rosario exchange down in Argentina came out and said and dropped their numbers 3 or 4 million metric tons below what the USDA had said, and that's been going on month after month after month. So I've seen, we in ag, we watch pictures, we look at pictures of these different places as such, but boy, our friends down in Argentina have had a rough go of it. Smaller crops and exports in the future in Ukraine. So you'd see the map right now, looks like they have moisture, but it's more of an issue of damage to infrastructure. Do they have the people, the equipment? Can they get the fuel? Can they get the fertilizer? Can they get the seed to actually produce? As we go forward, that depending on how quickly Ukraine can recover, that'll be a tightening up, their inability to be active in the corn and wheat markets it'll just be a tightening factor in the world supply demand balances. They were third or fourth largest corn exporter before corn and wheat exporter before all their problems happened, and you have to wonder just to what degree they're going to be able to recover and get back to that type of productivity anytime soon. And I've shown this before just as a reminder. So particularly looking at the Argentina situation, when is the gap? When does corn that would normally come out of Argentina or soybeans that would normally come out of Argentina, when will it not be on the market? Well, we're sort of in it, particularly for second crop soybeans and for corn. Again, the world's kind of hanging its hat on what's coming out of Brazil, which has looked pretty good. And it's kind of a horse race between the anticipation of good crops in Brazil, of poor crops in Argentina. There was some delayed planting of second crop corn in Brazil, which if I understand it right, pushes their crop development out into the beyond their optimal window, a little bit hotter. So if they suffer problems on that later on in the year, well, that could be something that could help us in the corn market, just for lack of all that competition that could be coming out into June, July timeframe. So we'll see. So you kind of look around for nuggets of what could work, what may happen, and the second crop corn situation in Brazil is something to keep an eye on. We already know there's problems in Argentina. Impact of possible geopolitical conflicts. I'd shown this before. Ukraine-Russia war. Really, before we were more hopeful of prospects of that ending and coming to a stalemate, but that it just seems to go. Again, I'm not a political scientist or political economist, but prospects of that ending and the differing grain trade impacts based on is Russia going to let the grain move this time or not? All that just keeps percolating out there. And then before, we just had a question mark on this on China, Taiwan, saying if this occurs, it would impact the global economy along with the grain trade. But there have been some serious tensions, military maneuvers of China around Taiwan of late, and so I don't know that when we listen to factors that are affecting the grain market, I don't hear grain traders talking about China, Taiwan. So it'd have to actually occur, and if it did, then it really behooves us to figure out, well, what would do to prices? Well, direct impact would be if it disrupts trade, then it affect U.S. soybeans, it would affect grain sorghum. Other ag commodities would be, if not directly, at least indirectly affected. U.S. corn. But what happens in those situations? If I'm thinking correctly, and I sure invite your comments on this, the first thought when something like that happens is probably negative. People go to cash; they don't want to be exposed to it. But then we sit back, we try to figure out the direction of movement and realize that, yeah, grain's probably still going to move one way or the other. It may get to the same place, but not directly. And then the world kind of starts switching places and changing chairs around. So at the end of this, I don't know. I think that if we have an initial downward move, we'd recover some of that back, and then we'd just be warily looking around to see where the flows would come. If there's anything that weakens China's hand, it's that their own economy reportedly is not doing that great, and they have ongoing issues of their own internally to deal with. So welcome to the morass and the challenge of understanding the interaction of the US and China in all these grain markets. Spring planting, feed grains and oilseeds with tight stocks across crops. And I'll show you the graphics. They are tight internationally. Any threats to planting the 2023 U.S. corn or soybean crops would cause strong price volatility. And right now, I don't know that we have dryness. There's wet. There was snow up in the Dakotas. We'll delay planting. Sounds like a repeat of last year almost. But I don't know that threat has emerged yet. And right now, we kind of watch the soybean corn price ratios to see what is being favored. And you look at this morning's latest numbers that I pulled off: 1309 November's soybean futures, D's corn 562, ratio of 2.33, and we really consider 2.3 as neutral. So it's kind of an even game right now, and one's not favoring the other. However, we'll once we get into the heart of planting, we'll see if we have any threats emerge, and then see what goes on. If we have a threat to corn planting, I would imagine corn futures would start to move higher, soybeans would recede, and that thing would start to favor corn, trying to encourage anybody that can still hold on and plant corn, say a month from now, if you have problems, to plant it. But it's not here yet. And new crop price competition likely to continue for a good while yet. Here we're in mid-April. We'll watch that through May and see where it goes. USDA reports often a driver of grain market volatility. I note that Doug Bounds is on here from USDA NASS. And Doug, we wait with bated breath for these reports, particularly the next. Well, we'll have the May WASDE report will come out here on May the 12th, and that'll be the first one where we actually get the WASDE reports giving numbers that project the new crop marketing year. It'd be the 23-24 marketing year for corn, for soybeans, for wheat, for sorghum, and generally there aren't any surveys in those. Those are numbers, trend-based ERS calculated figures. World Ag Board involved there, of course. So that's coming. We won't actually get those other more solid numbers for corn, soybeans, and sorghum until off into August, September probably. But for wheat, they'll come sooner as we have crop surveys. But then, we came through the prospective plantings report just a week or so ago at the end of March. Now the next big acreage report, a market mover, is scheduled for June 30th. So along with that, there'll be a stocks report, and that June 30th date, potential mover in the markets. Strong demand pull for feed grains. I just want to put this out there that summer demand for new crop supplies. Again, it seems that people are full up, or they have adequate supplies. We were scrambling earlier. People must have their needs met, etc. But if the dry conditions in the Western Corn Belt stay as they are, how can you not think out here in the western states that if we're dry again, if we don't have successful crops, that we won't? But in the central U.S., Iowa, Indiana, Illinois, Minnesota, if they have successful crops, probably another situation where the futures back there will probably pay attention to the Central and Eastern Corn Belt, but our basis out here would be strong again. That's how we'd respond to it. That's what we did last year. So I guess stay tuned on that. It seems right now, unless moisture comes, that we'd be due for a repeat of last year's. But you need to be careful saying that, because that issue last year with basis was, quote, wild out here. But if we have dry conditions, how can you not be wary of strong basis coming back in again to give us a situation similar to 2022? Are grain markets at risk to fall sharply in the last half of 2023? Well, yes, with tight beginning stocks across these crops, less risk probably of major declines. Early on, if we were sitting on 2 to 3 billion bushel carry in, well, we'd be probably already much lower than where we're at, but we're not. We're sitting on about half of that for corn. And so it would probably delay the response to good crop conditions coming along in the U.S. overall. Then if crops look good elsewhere, hopefully good here too, then yeah, then we'd be at risk to grain sellers starting to discount the possibility of short crop in 2023. And when will that be? You know, we're sitting here mid-April. It's going to have to for that to really shift around for the Western Corn Belt. That moisture is going to have to start to come. It certainly can, but it hasn't yet. Probably by late May, early June, if moisture starts to come, then that could be where we find ourselves. If in summer 23, U.S. and foreign crops prospects are okay to good, then grain markets likely slide lower in fall 23. I think you stand back and look at it. You know, our climatologists have stated that the La Nina weather pattern that's so tied in with dry conditions is receding, going away. They're looking towards El Nino coming on. So I think that the market is expecting this. They're expecting El Nino to come in and our drought likelihood to recede. So we have a bunch of high-priced inputs, crops at risk, but yet this issue out here of the broader futures market probably thinking pessimistically price-wise. So we've got several minutes left. I want to move pretty quickly through some specifics on some of these markets. Feed grain markets, you can see corn futures this is a continuous weekly chart. Really, we in kind of a tortured up and down manner have been moving lower from about last November. Note that the high is 706.5, 606 and 3/4 here in March, back up to 668. So we've been sideways to a bit lower, and if anything of late, a little bit lower. You can see this is the May contract, and we have come back up. It had got down to about 608, 607. Again, first part about March the 9th, 8th or 9th. Now about 666 and a quarter. And you know, we're not chartists here at K-State, but it is good to know where prices have been. So we're back up to an area where we've been at. If it moves higher than this, about 688 is where it had been. If it moves above that, about $7, about 710 is where it had been. So I guess, Mark, in terms of what you're looking at, this isn't Dees corn. This is the May contract, but the proportional moves for December from here on up would be what we'd be wondering about for our pre-harvest marketing plan. Just did want to show you here. I try to put a picture up of just 6 locations that we've just picked out this week to follow for basis. And you can see some basis trends generally across the state, sideways to a little bit lower, a little bit of weakening. Stronger basis, of course, positive basis out in the west. Hutchinson, still positive basis, still positive in Salina. Heading towards par in Topeka, still positive in Columbus. And note, those are the last 4 years, green being 2000, purple 2021, weekly basis levels. Positive numbers show cents over futures, red last year and the blue this year. Grain sorghum, a little more middle of the pack, pretty much a lot more sideways. Although we've been seeing some export movement in sorghum, we really haven't seen basis in these locations start to jump yet. Would say that if you look at the futures and look at the current marketing year, 2022-23, starting September of 22, going to end end of August 23, and look at what the futures are saying in terms of the cash prices we have, and taking the basis forward and tying that in with the remainder of the marketing year. It's projecting about 614 for the next marketing year, starting out at, well, it's 502 So Mark, that question, do I start marketing for next year? Well, it's possible, but you can see the trends in the futures. They're very much front contract oriented, and then we base off of that. So right now you've got these two numbers, the USDA projections, current projection for this marketing year is 660, which is sharply higher than that 614. We can get there, but if the USDA is right, you'll have to have prices rally pretty strongly. Now, coming into latter part of April, May, June, July, and August to make up that difference. For next year, they're projecting 570. That was out of their Ag Outlook conference. Futures are saying 502. So just be aware that the futures are tending to be more pessimistic than the USDA public forecasts that are out there. I put these forecasts, Mark, I think this is what you're probably referring to. My issue with the USDA numbers is their yields. They plugged in, if you see up here, 181.5 bushels per acre for their projection that came out of their Ag Outlook conference. We haven't ever been above 177, and we have enough dryness around in Western Corn Belt that I'm more. It's only Dan O'Brien's own thought. 35% chance. So maybe the USDA is right, and we get tremendous yields. Things go great, but more like a 2/3 chance that in so many words, let's tone it down a little bit. It seems that the 181 is pretty optimistic given what we're looking at, and at least go with a good yield and see where that takes us. With a good yield, we're you can see we're about a 1.5 billion bushel carry out, 14.8, 14.9 billion bushel crop, something closer to 625 for where we're at. So again, so this would be my own thought on where we're going. And note that there's the USDA projection with 181 bushels an acre, 181.5. There's the KSU one with 177, and it won't be long if things stay dry that we'll have to start toning that one down too. And there's the price differentials. The difference between $5 and $6 is on the market. So that's 15-18% differential in selling price based on your assumptions on what that U.S. yield will be. And did want to show you this for corn. This ending stocks to use this year, 295 million metric tons, 26.5% stocks to use. That compares to last year down in here. Well, I guess a couple years ago, and an older crop market year with 9-year low back here, just a little bit up from that, 25.6%, 20.3% stocks to use. In so many words, we've been tightening up stocks to the place where the world's pretty hesitant to go much further down. If we get much further down, much tighter than that, we start rationing. You raise the price. World less China is a better way to look at it, to not deal with the vagaries of trying to figure out that China's ending stocks figures, whether they're correct or not. And you take China out of the equation, down to 88 million metric ton, 10.25 stocks to use, just a little bit above where we were a couple years ago at 10.14, which was a 10-year low. So you look at this, and so Mark, you can say, well, gosh, O'Brien, gosh, Dan, you have more optimism. It's not so much optimism. It's more real caution that world stocks are just pretty tight. And it doesn't seem that we're solving the situation in any quick manner. You can see this is just another way of showing it, and note that differential between all the stocks outside of China. You add China in, it's, you're adding almost 200 million metric tons. And just did want to show you this. Most of the time you look at these charts, you say, what, how do you make heads or tails out of that? What stands out to me is that because all these commodities are tight together, that we're kind of jumping into some new price responsiveness areas. It happened last year, 21, 22, 23, for the same stocks to use as we'd had before. let's take that 2022-23 at 660 US price and add in the dollars impact. It looks like 809 to the world. At that stocks to use before, we were at $5. Now we're $2 or $3 higher than that. So the dollar makes a big difference, and just all these grains being tight together pushes us higher. And did want to show grain sorghum. Adding into the fray in terms of jumping into a new area because of all these crops being tight together. Take a look at soybeans. You can see the soybean futures have generally, since about early February, been moving generally lower. With South America crop coming on, no doubt in Brazil, kind of ignoring and thinking that will outhorse the gains in Brazil to outhorse the losses in Argentina. We shall see. And you can see the May futures, 15 and a half, closed on Friday, again, up from lows of really pretty volatile, up about $1 in the last week or so. So again, concerns about availability of beans. Basis, some downtrends, some holding up decently, generally some weakness happening in the last 1 or 2 weeks. But I've seen in some of these locations when the basis for beans fell off, I start in my own thinking, my thoughts are, we're anticipating Brazilian beans coming in and less demand pull coming out of the US. So that's at least how I interpret some of the recent weakness happening in soybean basis. And note for current marketing year for beans, projecting about 14.15. The USDA projected about 14.30. Next marketing year, 12.85. Pretty flat though, no seasonality, just flat projection. 12.90. So USDA's projection. So the soybean projections pretty much in line with what the futures are thinking. But again, corn, a lot more pessimistic. Projection for you have the USDA figures. They're at 52 bushels an acre. And my own thoughts are that I just think that USDA's projections are heroic early on. If you come in with a 50 and a half bushel per acre or a 49 bushel per acre, to me, it seems like you're getting closer to where things would be at. And so Mark, I stand for just criticism on this if someone wants to take me to task on it, but the USDA's projections with that 52 bushel per acre figure, if we get it, wonderful, it'll be great. But if we don't, you start tightening up pretty quickly. And you know, there's a 15 and a half down there at 17 and a quarter, that if we don't get this, if we start getting like this, then there's potential for soybeans to move higher. And so you can see the USDA's projection for 14.30 down to 12.90. That's where they stand. And you can see by the time I kind of re-engineer what they've got, see where things would think they'd be more likely to land. And the percentages, there's 50% chance that we're appreciably higher than the USDA's figures. And just to show you quickly then for ending stocks for soybeans, for the whole world altogether, about 27.4, 27.5% stocks to use. But again, just as these other crops, we're in holding patterns. The world isn't that anxious to get much lower than where we're at for soybean stocks, just like it wasn't for corn. And if we do get a shock that takes us there, prices will have to kick in to ration difference. Take China out of it, and if you take China out of the situation, take their stocks out, we're at a 9-year low for world soybean stocks. So it is as it is. And you can kind of see that the difference there between the rest of the world and China included for stocks. Again, China just holds a bunch of stocks, or there's always questions about, there have emerged questions about the quality, the quantity, et cetera. So given all that, it seems good to have both of these views. And note this again, that this is a really messy chart, but again, we're we've got all these commodities all tight together. So if you take that stocks use figure that we'd had for 2022, which is about 26, 24, 25, 26%, and bring that down to not that many years ago. Well, before inflation kicked in, this is 2013, 14, we'd be closer to $12. But through inflation, through jointness in the stock, in these crops all being tight, we're pushing to areas like this price-wise. We'll finish up with wheat. Take note here that in general for wheat prices, we had been up to over $10 back in October of 2022, and have generally in kind of in sort of an up and down path worked our way lower now. And a whole bunch of stories there about that tie in with wheat out of Ukraine being available through UN agreements, Russia agreeing to let it happen. It just seems you watch that market, and when it goes up and down based on whether it's being affected by whether Russia gives a hint that they're going to allow shipments or not. So whether that's the key issue to watch in the world markets, I don't know, but that's what one of the big issues they are watching. Note the May Kansas hard red winter wheat figures. This is Friday's close. A little bit of strength here of late, 878. Note where we were last October, up to 1025 last summer. In the midst of the Ukraine-Russia hit impact on the market, we were up to 13. So now we're down to here. So if our dryness continues, we fall short sharply on the hard red winter wheat crop, will these price levels, which are relatively speaking pretty low compared to where we've been, will they hold? It's based on supply demand alone. I would think that the dry conditions would take that thing higher. You can see the basis for wheat pretty level, pretty across the state, very similar patterns almost everywhere. So we're not seeing exports come in and grab attention, and demand basis narrow up to pull wheat out of the countryside. And note current marketing year projected at 873, next one 848, and the current projection 890 by the USDA. So yeah, we're about 17 cents low, about the same for wheat, etc. So here I've shown you three of these things, and wheat and soybeans not too far off, but there's a difference between the futures and the USDA's projections of prices for corn. And then for wheat, showing in essence again, USDA has their projection for this coming market year of 49.2 bushels per acre, and I think you get kind of blinded by what you see out your window, or when you walk out into the fields. So I'm plugging in lower US projections, 46, 42, and looking at the price impact, and looking at going from 850 to 885 to 950 if we get a real drought situation going on. You can see the tightness of stocks. Generally, we're tightening up stocks, estimated by the USDA with that optimistic projection to grow stocks. Again, and I'm kind of questioning that. There's the USDA's projection with their really no crop loss scenario. But you plug in a crop loss scenario, then I'm looking at 885, 950 rather than the 8 or 850 USDA is going. And that finish up then, world wheat, we're at the world wheat stocks, China included, at an 8-year low. Take China out, we're at a 15-year low. So I know we're concerned about what we have going on here in the US and whether we're shipping many exports or not, but the world situation for wheat is just pretty dire, and we're tightening up, and doesn't look like well. And you see this situation, 19.3%. We were that tight back in 2007, 2008, and again you see this moonshot to the left on so. And because of how tight that is, you can see wheat prices moving pretty strong. So I thank you for people that have stayed on. I've gone just a couple, 2 or 3 minutes over. Rich, do we have any questions that have come in?
So I saw indicators in the April NAS crop production report of price support for Milo this year. What's your take on Milo's prospects? So they're asking about that more.
Well, a couple thoughts on Milo. I'm really curious on the acreage for Milo. I think the national acreage projected to be up 2.7, 2.8%, about the same percentage as for corn. I wonder out here in Kansas, under dry conditions, will we plant Milo with maybe a little lower cost of production upfront than corn, where people are in just that much more of a desperate, tight situation. Milo is finding its way into ethanol plants, is my understanding. Some of the recent moves export wise have been good, but still the Milo export pace is bouncing along the bottom of anything we've seen in the last 7-8 years. So we're just not having strong Milo exports. But what we do sell, still China dominates that market. I guess with one other thing with Milo, I wonder how the Mexico GMO issue will play out between corn, Milo, non-GMO corn versus non-GMO corn. I don't hear a lot of discussion of those issues, but that's something to ponder heading off and down the road. So what are my prospects for Milo? If we're dry, we'll take any feed grain we can get. That's my thought. If we can grow it, and if Milo can grow under drought tolerance in these situations, it'll find ready hands to grab hold of it domestically, much less on the international side. And you'll have to read me those questions, Rich.
Okay, sorry, I just realized that. Is there any input on the PNW, Pacific Northwest white wheat market, soft white wheat?
Guy Allen, are you on here? I think you might be able to help me on that, because you're heading out to to Asian markets on that. Do you have any comments on that white wheat market?
Yeah, just hang on a second. Let me grab my notes from Friday. The thing that keeps me optimistic white wheat is Chinese demand. You see, last week's USDA report indicated China's now the biggest world wheat importer. What's hanging over that white wheat market is the Australia production, as last year they had their 3rd record crop on the back of good rains down there. With the weather patterns shifting from La Nina to El Nino is actually drought for Australia. But look, they're planting now. They continue to get good rains. We're going to have stiff competition on that white wheat from Australia, particularly in those high value markets. I think value wise, it's priced reasonably well. It's not quite as strong as the hard red winter wheat, but it's it's all going to depend on planting in this spring wheat situation in the north. So we'll sort of watch that as it goes forward. But look, I think the Australians will be there for at least another year of good production there that we're going to have to compete. Their biggest problem is their export capacity. They've put quite a bit of temporary loaders in the last couple of years, and they have ramped that up significantly. But we're going to see what's going to limit that upside is Southern Hemisphere Australia production. But on the flip side of that is the ocean freight has come down. It's minimized our comparative disadvantage on the transportation to those Asian markets. I don't know if that helps or not, Dan.
Yeah, Guy, that helps tremendously. Thank you. I found a way to look at the chat. There's a question from Jermaine. If wheat is so very short, will that affect the D's corn prices coming this spring with the dryness in a few states and still snow in the northern states? You're kind of so what you're talking about there, let's see if I want to make sure I'm catching that. So you're wondering about if wheat's short, this, okay, will affect so I assume you're talking about planting. So if we these corn prices with dry few states, still snow in the northern states. Well, I think if I'm thinking correctly on that, the first place I go, the direct effect would be, do we feed wheat? And out in these areas, I think we're probably open to do that in places like in the Southwest Kansas, et cetera, but it's not our first choice. But I think that to me, it would just provide, if wheat's short, it kind of takes away the feeding threat, because wheat's going to be high priced, and anything, if I'm hearing you right, Jermaine, then anything that wheat would have had as a threat to corn because of a competitive feed issue has gone away. So it's not going to bring corn prices down. I think there'll be enough other things that corn will have to deal with, if I'm coming correctly at what you're saying.
You bet. Hey, Dan, I think you are. But I think part of that too, then, wouldn't you say that, yeah, the dryness in the wheat kind of taking it off the table as far as any kind of a substitute for feed grains. The wetness up north, again, is melting very quickly. So, we got a long ways to go to see if that really does impact planting rates and things like that. But all those things should help support December corn futures here this spring. Right. I mean, let's say, and I think that's maybe where we're heading here with this. If we would see, oh my gosh, the wheat tour comes out next week, and not next month. The Wheat Quality Council wheat tour is going to be May 15 through the 18th. They'll be stopping in Colby on the 16th, Wichita the 17th. For anybody who's around those areas, you got to pop in and listen to see what people are telling you about the crop. But the point is, if we find that, man, we're just abandoning wheat left and right in that western third of the state, that's got to run those prices up, and that should also bring, help December corn futures a bit too, right? And give us that chance. And so when we look back at our plans, even though, my gosh, we're sitting here, we have support at 550 and we're trading today in the low 560s, there's a pretty good argument out there. And I think that's what you're making, is that we're going to see some upside. There's some pretty good shot here that we're going to see a pretty good, or at least a good rally. And we should not be maybe taking some of these prices currently. We ought to be keeping our powder dry and let's hang on here for another month or so, right?
There's a dangerous conversation that you can have. There's the idea that the futures are a consensus forecast of things, and the futures are right. but that doesn't mean that they're always considering factors now and in the future that they can or should be considering. There's a general narrative thought, and to me, it seemed that the general narrative of the futures has been that of grain futures of late have been that moisture's coming, that we're not going to worry about a lot of threat, that those issues are out in front of us, that we'll not worry about those things until we have to worry about them. So if anything, there's kind of a myopic narrative that it's not here yet to worry about. But as we've seen in hardwood winter wheat, that's not going to, we have a lot in the next 60, 90, 45, 60 days that we have to worry about in some of these crops. And then it'll be time to watch and see what happens. I had a question on the side. Farm Journal had an article saying that Kansas would be one of the 6 most affected states if there were to be a Mexico GMO ban on corn. I think we rail. How does Kansas get corn to Mexico? I think via rail, as I've talked to my friends in Garden City, largely. You can no doubt go through other means also, but yeah, the USDA Ag Marketing Service they have a price series for prices at the U.S.-Mexico border at key points for rail for grains going down into Mexico. So, Ward, that'd be how I would view that. Very good. Well, so are there any other questions?
Go ahead, folks, if you have them.
Well, Mark, then I'd ask you if to come back full around. How did what we talked about in some of this latter part? How does that affect your perspective on those price scenarios that you're talking about?
Well, I think, as we look at our plans, and if folks are working plans like us, it would indicate to me that these prices, we've got upside in all the grains, wheat, corn, and soybeans. And even though, my numbers would suggest that really beans are the one that's clearly still, futures are still above our cost of production. Pretty much everything else is borderline to maybe not even covering it. There's hope to sit there and say, hey, let's hold off. Let's keep passing these decision dates and wait to see if we can do some catch-up sales, because there's a good chance that we'll see some prices rally here over the next 60 days, 60 to say 90 days.
And if you want to trust your own cost of production more than ours, we're full economic cost. We're not going to do anybody any favors on low cost at all. But if you're more efficient and effective, then you think about that corn number. If someone isn't at 580, if they're at $5, well, you'd be pricing. You have green light to go. So does that sound okay to you, Mark, as a perspective?
Oh, absolutely. Given the fact that we're that close, both really in wheat and corn, as far as, our futures covering it or not. And then when you look at the basis from place to place. So yeah, people really need to look very, very hard. And we always emphasize that, but boy, definitely this year, you really need to look hard at your own situation, because there may be some people that, no, this is covering my cost. Maybe I should take some protection. But knowing, look at the forecast, looks like we do have better odds for a bit of a rally here, and that the 550 on the corn, looks pretty likely to hold for at least the near term, and we could see a rally. And so, I still wouldn't get in too much of a hurry, but you're absolutely right. People need to look at their own situations, that combination of what is your local basis. Corn basis out in Western Kansas, incredibly strong already. So absolutely, I agree 100%.